Well, banks are going to get caught up in the second wave of this global depression because, they are either lenders or direct asset owners. And so as people lose their jobs and as businesses are shut down, anyone who's lent money is going to have a hard time making payments. So I think banks are caught there. And of course, more recently, we've had some talk about the potential for negative rates implied in some of the futures markets. And of course, that terrifies investors who really view bank products as spread products.
So, Tom, given the pain they've already suffered, they're what, 33% or so off the highs? Would you buy? I know you're pretty bullish overall on the market.
Yeah, we think you've got a barbell yourself right now. So own some high quality secular growth names, which have been like FANG or tech or the cloud. But you also want to run into the epicenter of this crisis. This is what worked in October 2008. So even if we were 5 months from markets bottoming, still made money on an absolute basis buying things that really are at the sort of bullseye of this crisis. And so I think high quality financials make a lot of sense, and some of the high quality leisure and travel, retail names, et cetera.
Bob, do you agree, or do you think there's more bad news to come for bank share prices?
I agree with Tom's comments about the longer term. I think it's a matter of timing from where I sit. Think about it. Just a month ago, we got first quarter bank earnings. They were far worse than people thought. Credit provisioning has not yet ended. That'll be a great signal for me. These are among my favorite cyclicals for a bunch of reasons, but I'm just not prepared to go there while there's concern about when credit provisioning is going to peak. And I think that's what has investors spooked. Before I came on the set, I looked at the 6 big banks. They're all down today. Some of them, yet again, 2% and 3%, and their year-to-date performance has been horrible. So I don't think the market's ready to go there. It will because of the cheapness of the sector. Their balance sheets are much better shape than they've been. Credit provisioning is the issue I'm really watching.
Yeah, Bob makes a point there, Tom, as far as we still don't know the full extent of the damage. I just mentioned the Fed and its financial stability report warning of bankruptcies, warning of severe household and business pressure as a result of this pandemic. So how do you feel confident buying the banks with that still big unknown?
Those are really important factors, and I think your comments earlier were actually spot on. But what you have to keep in mind is in the 2008 crisis, because of what was happening with that recession, banks were subject to increased and much more burdensome regulations. What we're seeing in this crisis is the willingness of regulators to ease some of these restrictions and capital rules. And so banks are sort of essentially set up to make a lot more money when the cycle turns. So I think that the opposite's happening, which is a lightening of regulations, and that really does have a positive NPV impact.